how do you explain what the market is doing today in the face of more than 3 million people claiming unemployment claims? How can the market be up 900 points, 4% in the face of that?
Look, some of the market move today is based on the fact that the market has been trading off of a complete lack of information. So estimating jobless claims, estimating unemployment rate, estimating decline in GDP has really been an exercise of wild swings all over the place, as you have mentioned on your show over the last couple of weeks. What we got today was certainty on how bad this is going to be. And even though it's dreadful and really just shocking, and when the number came over, it was shocking, there is a sense of the direction of where this is going. And so markets like certainty, and at least we can count this. Now, the other thing that we have is we have this large bazooka coming on the solvency side from the congressional bill that was passed. And this is going to keep households afloat at least for the next 6 to 8 weeks. That will go a long way.
So, Scott, are the numbers that we're going to see, whether it's 3.3 million or whatever the total number was of jobless claims, are the numbers we're going to see over the next few months, are they really going to be meaningful? Are they just going to be so outlandish that you really can't use them to value assets?
I think we're in for a whole run the next months or even quarters of economic data that falls squarely into the category of crazy make-em-up numbers. As shocking as the initial claims for unemployment number was this morning, in some ways it really wasn't. We all knew it was big, but what really is the difference between 3.5 million initial claims and 2.5 or 4.5? What's the difference between a 20% decline in second quarter GDP and a 35% decline? I think Alicia's right. Part of what's unnerving the market, part of the reason that prices are divorced from reality is that reality is divorced from reality. And I think that's the environment we're going to live in for some time to come. I think the VIX is capturing that. What we're seeing over the last 3 sessions is just volatility on the upside, which certainly feels a lot better, but it's still volatility. And I think the market is still seeking around for some kind of anchor on which to trade.
Alicia, I want to get your thoughts as an investment thinker about what someone. I'm a hey boomer, okay? I'm a proud baby boomer. Not counting the years to my retirement, but not unmindful of that. If I'm in my 401k, should I even look at what should I be doing with my 401k right now?
Look, that is the big question out there. And I think the best advice we can give today is you need to have at least a 2-year time horizon, because we've done studies on the decline in markets. And if you go down 25%, for the most part, you're higher than that 25% downdraft after 24 months. Not always, but after 2 years, you can see the other side of this. So even if we get a U-shaped recovery, meaning we trickle around on the bottom for a while before we go higher, versus a V-shape where you get that rocket ship up, you should be doing better price-wise in the market once you've come down this far. You know, in the end, we are our own worst enemy, and all of our plans for investing can fall by the wayside when people follow this way too closely. And in the end, if you're a long-term investor and you don't need the capital for at least 2 to 5, 10 years, then it's probably fine to start edging in here. Having said that, this is a very, very treacherous market. And the truth is, like 3 days of going up and we're all bulls again, we just have to be careful. April will be ugly, and we should be expecting that.